Section 2:2 Understanding the Volatility Index, VIX, 2.2 Market Sentiment and Fear Gauge. The VIX is often referred to as a fear gauge because it reflects market participants' expectations and emotions regarding future volatility. It provides insights into the level of fear or uncertainty prevailing in the market. Here's a closer look at the VIX's role as a fear gauge and its connection to market participants' expectations and emotions. Expected volatility. The VIX measures the market's expectation of future volatility over the next 30 days. It is derived from the prices of options on the S&P 500 index, which are influenced by market participants' buying and selling activities. Higher VIX levels indicate higher expected volatility, suggesting that market participants anticipate larger price swings and increased uncertainty in the market. Uncertainty and fear. Market participants' expectations of volatility are closely tied to their uncertainty and fear about future market movements. During periods of heightened uncertainty or fear, the VIX tends to rise as investors seek to protect their portfolios from potential losses. Market events such as economic crises, geopolitical tensions, or unexpected news can trigger spikes in the VIX, reflecting increased fear and caution among investors. Risk perception. The VIX is also related to market participants' perception of risk. When the VIX is high, it suggests that investors perceive higher levels of risk in the market. This can lead to risk-averse behavior, as investors may reduce their exposure to riskier assets and shift towards safer options. Conversely, when the VIX is low, it indicates lower perceived risk and can lead to a more risk-tolerant market environment. Emotional impact. Emotions play a significant role in shaping market behavior, and the VIX captures some of these emotional aspects. Fear and greed are two dominant emotions that influence market participants' decision-making. The VIX reflects the fear component, as higher levels indicate increased fear and aversion to risk. It is worth noting that market sentiment and emotions can be contagious, contributing to market dynamics and amplifying the impact of fear or panic. Contrarian indicator. The VIX can also serve as a contrarian indicator. Market participants often exhibit herd behavior, and extreme readings in the VIX can suggest sentiment extremes. For example, when the VIX reaches exceptionally high levels, it may indicate excessive fear and a potential buying opportunity, as markets can become oversold. Conversely, extremely low VIX levels may signal complacency and euphoria, potentially indicating an overbought market and a higher risk of a correction. It's important to remember that the VIX is not a crystal ball, and it has limitations in predicting precise market movements. Market dynamics are influenced by a multitude of factors, and the VIX is just one tool among many used to gauge market sentiment. Therefore, it should be used in conjunction with other indicators and analysis to make well-informed investment decisions. During periods of market stress and uncertainty, the VIX tends to exhibit specific behaviors that reflect heightened fear and increased volatility expectations. Here's an analysis of the VIX's behavior during such periods. Spike in VIX. Market stress and uncertainty often lead to a sharp increase in the VIX. When significant events or news create uncertainty, investors become more cautious and seek protection. This increased demand for options as a hedging tool drives up their prices and, consequently, the VIX. Spikes in the VIX can be observed during financial crises, geopolitical tensions, economic downturns, or unexpected events that impact market sentiment. Volatility clustering. Market stress tends to be accompanied by periods of heightened volatility, which is reflected in the VIX. During these periods, the VIX can stay elevated for extended periods as uncertainty persists. Volatility clustering refers to the tendency of periods of high volatility to cluster together. This means that once market stress and uncertainty emerge, they often persist for a certain period, leading to sustained elevated levels of the VIX. Fear contagion. Fear and uncertainty can spread among market participants, creating a contagion effect. When negative news or events impact market sentiment, fear can quickly spread, leading to a collective desire to reduce risk exposure. This fear contagion can be reflected in the VIX, as heightened levels indicate a broad market sentiment of fear and risk aversion. Increased sensitivity to news. During periods of market stress, the VIX tends to be more sensitive to news and events. Market participants closely monitor developments, economic indicators, and policy decisions, which can have a significant impact on market sentiment and volatility. As a result, news releases during these periods can trigger rapid changes in the VIX as investors reassess their expectations and adjust their positions accordingly. Reversion to normalcy. While periods of market stress can lead to extended periods of elevated VIX levels, eventually, markets tend to revert to normalcy. As uncertainties dissipate or get resolved, and market sentiment stabilizes, the VIX gradually decreases. This reversion to normalcy can be observed after crises or periods of heightened volatility. As markets regain stability and investor confidence, it's important to note that the VIX's behavior during market stress and uncertainty can vary depending on the specific circumstances and events. Therefore, it is essential to consider other factors, such as market fundamentals, economic indicators, and geopolitical developments, when interpreting the VIX's behavior during these periods.